Hi, hello. Welcome to the Warrior Stocks podcast and a Kaon.com production. My name is Max Beach, and let's get started. Please note that the content of this podcast is for informational purposes only and is not intended as investment advice. Okay, this is maybe my seventh try at making this episode, but welcome to the Warrior Stocks podcast, episode 3. We're going to go over all the economic data from this week along with the market data because this week was quite a turbulent week. I'll give some thoughts on top of it and things that I'm looking at. Let's just start off with the data and then go from there. The S&P was up 1.34%, the Nasdaq was up 0.7%, and the Russell 2000 was up a whopping 5.6%. CPI data, so inflation data for June, the expectations was that the inflation was going to increase by 0.1% month over month and 3.1% year over year. What actually ended up happening was we were surprised with some cooler inflation. We saw that prices actually decreased 0.1% month over month and increased only 3% year over year. This comes after a reading of 3.3% in May. So inflation's cooling a little bit. That's kind of interesting. It follows an unemployment reading of 4.1%, which is an uptick. It's still a historically low unemployment, but we're starting to see the softening in the economy that would lead us to believe that the Federal Reserve is actually going to cut before the end of 2024. And when I mean cut, I'm talking about interest rates. And that's been the name of the game in investing recently. It's all been about interest rates and expectations. Coming into the year, we thought that interest rates were going to go down maybe 6 to 8 times. Then inflation became a little stickier. So then the expectation became zero cuts. And now we get this cooler inflation, and we're at like maybe 1 to 2 cuts now. Jay Powell the other day said it's likely that we will get a cut maybe soon. That's interesting. And it's also interesting that we saw such a huge gain in the Russell 2000, whereas the Qs and the NASDAQ only went up 0.7%. What does this mean? It's all very interesting seeing that small caps are actually trading like the riskier assets now compared to tech. Does this have something to do with the AI bubble being too baked in? Are we seeing valuations go so high for tech names that a cooler inflation data doesn't really affect these companies as much anymore? It's all very interesting. I'm going to give another little bit of economic data to paint the picture before I kind of give my thoughts. Not kind of give, I will be giving my thoughts. Consumer credit rose $11.3 billion in the month of June, compared to $6.5 billion in the month of May. Estimates were $8 billion. That's quite a big difference when we're talking about billions. It all kind of comes together. So let's talk about the entire picture starting now. Big picture: inflation cooling, labor market softening, and then consumer credit increasing. And now the small cap stocks are booming, but tech and AI a little flat. The picture we're seeing right now is that if you want a riskier exposure, you might want to be in small caps. And if you're interested in getting on the AI wave, just know that the downside is probably more likely than the upside, meaning that expectations for these tech names might be so high right now that even an economic indicator that should be beneficial to these companies doesn't make the needle move. If anything, it brought money out of those names and into small caps. And so we kind of saw a trade where people were selling out of these names and then into these small cap names that they used to love and enjoy. So, how do we think the economy is going to fare coming up? Today, we started earnings season. Banks started today. I will be diving into some of those earnings calls just to see what some of these prominent CEOs are saying about the economy. But right now, let's just think about things. If inflation is cooling and unemployment is ticking up along with consumer credit going up, maybe we shouldn't be as bearish on second quarter 2024 earnings. I think what was happening, along with myself, and I'm sure a lot of other investors and potentially traders, were bearish on the Russell 2000 because unemployment going up would lead to softer earnings in a lot of these industrial names that we see take up the majority or a lot of the Russell 2000. That was my idea, kind of being on the other end of this trade, being more short the Russell 2000. Clearly, I misgauged how the rest of the the investors would be on the sidelines and jump into the Russell 2000 at the speed of light a lot faster than I would have ever thought would be the case coming up. I thought that people were, if anything, a little too bullish on the Russell 2000. I was clearly very wrong. But we're going to keep it moving. So when we're thinking about consumer credit going up, that really makes sense because if unemployment is ticking up, then people are going to have to take more loans out, not necessarily going to the bank, but just using their credit cards more, knowing that they'll have to pay it off in the future, even if they don't have those funds in the future. So that's something that we're going to have to keep an eye out. Maybe consumer discretionary is going to surprise this quarter. I don't know, probably not. But it's just things you got to start thinking about. Like when people are spending more on credit, how is that going to affect things? If the Fed actually does end up cutting, are we going to see a lot of interest rate sectors do quite well? We saw housing do particularly well over the last few days, and it's all going to be pretty cool to see. How is this all going to play out? I don't know. If unemployment stays flat, but this inflation keeps cooling, that's what the Fed obviously wants, and we're reaching a no landing scenario potentially. No landing means that we don't even have a recession. We just kind of go back into growth, sustainable growth without the fear of inflation. Some say that that is what is priced into the market right now. The soft landing narrative is not something that you hear spoken of as often anymore. Although I think I might still be on the side of there being some sort of hard landing, especially if we have any contradiction in fiscal and monetary policy coming up. But that's a little too far into the future to discuss here today. But if you do want to learn a little bit more about nearshoring, you can go check out the ArcBest post on the website. And you can also look at my Redwire post that talks about an exposure I would like to have, thinking that there's going to be plenty of military spending coming up. Where am I looking for ideas nowadays then? Nowadays, I'm looking for companies that are in good financial health, or if they're in bad financial health, they do have access to financing in an affordable manner that does not dilute my position too much. And so, an example would be a Redwire exposure. An example of quality would be that ArcBest exposure. I'm starting to look at Toyota, but maybe I'm not as bullish on it anymore. I'm moving in different kinds of directions right now. There's a lot going on. I think I will be looking at some sort of industrials coming up. I might do some more screens, but really, I'm just looking for more. I would like to find more stories where companies are going through changes. Maybe not so macro focused, more bottom up focused, and that requires more time and not as much screening. Uh, we'll figure it out, but I don't know. Right now is such a weird time. We're getting a cooling economy, but the S&P is at all-time highs. The Nasdaq is reaching these crazy highs. We're seeing small caps benefit the most from cooling inflation data, which it does make sense, but you would expect that to go along with big tech names. So it's just such an interesting dynamic. we'll see what keeps on happening with the election. We'll keep on seeing what happens with the Middle East and Ukraine. And there's just a lot of geopolitical tension going on these days that oil is still out there. We still see Warren Buffett buying energy. So it's a wild time to be investing in an economy like this. So my best read on things would be to say that you need to find situations. I'm going to keep on looking for situations. Wiley is an example. My most recent Achaon.com post is a situation where you have some backdoor AI exposure, but the probably the most core element of the pitch is that it's a company going through changes. It's a really old, dependable company that is going through structural changes and is following through on what it said it was going to do, and management is doing what it's supposed to do. I wish I would have found Wiley like a year ago because I would have seen all these different signals, but today there is more of an AI play there too. So I don't know. I'm not specifically looking for anything AI. I'm not specifically looking for anything risky. The only place that I think I am going to focus a little bit more on is military. I do think defense is going to do well maybe over the next few years. And that has a lot to do with my theory on fiscal policy going to be quite easy and then monetary policy is going to be quite hard as long as the Fed stays independent. If the Fed does not stay independent, anything that has inflationary exposure, you should become long, whether that's housing, whether that's construction, whether that's materials, anything that does well in an economy that's growing and being overcooked, that is what we should be looking at. And a lot of that has to do with the election coming up. So we'll stay vigilant on that. And I think that's enough for today. I didn't want to get too technical. I mean, I did in the 7 revisions to this episode. I think the way it's structured now makes more sense. Hopefully, I don't know. We'll see. This is my first crack at this thing. Just let's do a quick summary of what we talked about today and then we'll close it out. Closing things out, we saw the Russell 2000 boom this week. We saw inflation cool a little bit. We saw consumer credit balloon a little bit. We saw unemployment tick up last week, and earnings season is coming up. So maybe I won't actually be screening for many things coming up. I'll be more so focused on the things I own and tracking those sorts of things and potentially finding opportunities with companies that do end up disappointing, which I still think that there will be pockets of weakness coming up just because of the weaker economic data that's coming in. And yeah. Also, I said you should be long at one point. That is more of a euphemism. That's not direct advice. Again, there's no investment advice happening on this podcast. That was a disclaimer. Okay. All right. I'm tired. We're going to end this. Uh, Continue to employ your curiosity, continue to do the research, and I hope you have a good rest of your day. See ya. If you want to learn more about Achaon.com, you can visit the website at Achaon.com. Achaon is spelled ACHAION.com. You can also follow Achaon.com on Instagram, Twitter, and YouTube. The dot is spelled out DOT. Achaon.com.